If you're investing in India right now, you might be standing inside a bubble, or you might be standing at the beginning of India's biggest wealth creation cycle ever. Let's break it down. The Nifty 50 has delivered massive returns over the past few years. Retail participation has exploded. Demat accounts crossed 150+ million in 2024. SIP inflows have consistently stayed above Rs 15,000 to 20,000 crore per month. That's not normal retail enthusiasm. That's structural liquidity. But here's the dangerous part. Valuations. India's market has traded at a premium PE ratio compared to most emerging markets. That means investors are paying more today for future earnings. At times, Nifty forward PE has hovered above its long-term average. When markets get expensive, expectations become perfect, and perfect expectations are fragile. Remember 2008? Remember 2021 small-cap euphoria? When liquidity was abundant, everything went up. When liquidity tightened, reality hit. Now look at the macro backdrop. India's GDP growth has been strong, around 6% range in recent years. Corporate balance sheets are healthier than a decade ago. Banks have cleaned up NPAs compared to the 2014-2018 cycle. So this isn't 2008 leverage madness. But retail dominance has increased. Mid and small caps have seen sharp runs. IPO listings often see huge subscription numbers. When taxi drivers talk stocks, that's noise. When household savings shift toward equities structurally, that's transformation. Here's the real question. Is India expensive? Or is India just growing faster than everyone else? Compared to other emerging markets, India commands a valuation premium because political stability, demographics, China +1 manufacturing shift, strong domestic demand. But premiums can stretch too far. If global liquidity tightens or earnings disappoint, high PE markets fall harder. That's math. Now here's the twist most people miss. Even if we get a correction, that doesn't automatically mean bubble burst. Markets can correct 10–20% inside long-term bull cycles. That's volatility, not collapse. The difference between a bubble and a growth cycle is simple. A bubble runs on leverage and fantasy. A growth cycle runs on earnings and productivity. Right now, India has strong earnings growth, but valuations demand perfection. So are we in a bubble? Not yet. But we are in a zone where expectations are dangerously high. And when expectations are high, even good news isn't enough. The real risk isn't that India collapses. The real risk is that returns slow down, while investors expect miracles. That's how wealth transfers from emotional buyers to patient capital. Econ Matrix, where economics meets reality.